Property markets are entering a new property cycle. Currently, there are lots of mixed messages in the media, some positive, and there are still lots of negative messages. And this has led to many viewers of our regular Property Insider videos and listeners to our podcast leaving questions. They're asking for clarification. So in my chat with Dr. Andrew Wilson today, I'm going to ask him to answer some of your questions, which, if you're interested in property, are likely to help give you some clarity for what's ahead. And for those of you who don't know Andrew, he's Australia's leading housing economist. He's the chief economist of myhousingmarket.com.au. So he's well qualified to answer these queries. Welcome, Andrew.
Thank you, Mike.
Well, we're in a new year and there's lots of people still wondering what's happening to our Australian economy. Are we going to fall into a recession because everyone's suggesting it's slowing down and we're in trouble?
Well, it's interesting, Michael. 2019 was a year where the Reserve Bank, I guess, finally realised that things weren't as rosy as they had expected. We did see the labour market deteriorate, unemployment rising, although jobs generally were still growing. But GDP was down, inflation still too low, and incomes growth also still too low. Issues continue over consumption. The domestic economy continued to weaken in terms of spending patterns, retail sales, and it was really only the mining sector and government spending that kept our economy ticking over and with its head above water. However, it's interesting, Michael, I think by the time we got to the end of the year, actually things started to look a little bit better. We did have some poor labour market data over September, where we actually saw the unemployment rate continue to increase, but we also saw jobs falling for the first time in some time. But the latest data in terms of the labour market actually showed a fall in the unemployment rate and also jobs starting to grow again, although most of the jobs growth has been in part-time work. But when we look at the big picture, we've seen some early signs of an improvement in the global economy, Michael. The US Federal Reserve has indicated that it's unlikely to change interest rates in 2020, but they're sounding a lot more confident about the prospects of the US economy, which has very low unemployment, a reasonable GDP growth, and incomes are starting to grow in the US. And also the Eurozone is moving away. A number of economies are moving away from negative interest rate positions and have stated that they're going to try to move into a positive interest rate environment gradually. And of course, we have the Brexit issue now behind us in terms of the certainty with the landslide victory of the Tory party in the UK, which will deliver Brexit. So I think a lot of that uncertainty is now starting to at least ease.
So we've got some clarity on Brexit, and it looks like the US and China may also be coming to some agreement. But of course, there's that impeachment story that's happening in the United States. But coming back to Australia, we know the Reserve Bank is hell-bent on increasing wages growth, lowering unemployment, getting more people into jobs. What do you think is going to happen to interest rates this year?
Certainly, it's no surprise, and it's been indicated quite clearly by the Reserve Bank that rates would be likely to be cut again, perhaps twice, given issues with the economy. We've looked with better economic data internationally and some improvement with the end-of-year data that was published, that we may see the Reserve Bank now more inclined to keep their powder dry, perhaps for a month or two. Certainly the bias for rates is still down, and still down early in the year rather than later. But perhaps the Reserve Bank's got something to think about in terms of holding interest rates for a month or two longer. And I think that will depend on the end of year data that's published in February and March.
Property markets finished very strongly in 2019. It was a year of two halves. Do you feel the strength's going to continue in 2020?
Well, the upside certainly continued through to the end of the year, Michael. There was no sign of auction markets easing. Clearance rates remained at very high levels over the final weekends of the year. High clearance rates from what were very high volumes for December indicate that there's plenty of confidence in the marketplace from buyers and sellers, and that will continue into 2020. There's other issues that will fuel it. We have the first home buyer deposit scheme comes into force on the 1st of January. That will bring thousands of first home buyers potentially into the marketplace, and certainly the bias on lower interest rates is a positive for the market, and there's plenty of incentive to get into the market with prices rising quickly as they had at the end of the year for that fear of missing out energy, that particularly for first home buyers, but generally for most buyers. The missing link are investors, and if investors come into the market in higher numbers, which is likely, that will only fuel stronger prices growth.
Well, I know investors are keen to get into the market, but their challenge at the moment is getting finance, isn't it?
Well, it is, Michael. There's a sort of a conundrum out there. Some commentators are suggesting that it's lack of confidence from investors that's keeping investor activity low, but others are saying no, it's a lack of access to finance, that investors are keen to get into the market, but they can't because they're still restricted by these risk-averse policies directed to investors from the banks. I'm not sure why investors would be hesitant to get into a marketplace where prices are growing at, according to some models, at record levels.
And the opportunity to get into a market at the beginning of a new cycle doesn't happen very often in one's lifetime.
Right.
I guess the answer is you've got to recognise it. And that's partly related to the mixed messages out there, the worries about the off-the-plan market, the structural issues, the recession, maybe keeping a job. But our experience at Metropole is investors are very keen to take advantage of the opportunities, but the challenge is with finance. So we're moving into a new year. What do you think are going to be the major influences on our property markets this year?
Well, positive confidence is certainly that will drive the market through the year, just as negative confidence drove the market at the beginning of 2019. It's certainly got a head of steam up at the moment, most markets, particularly Melbourne and Sydney. We shouldn't be generalising because smaller markets are still just moving. Some signs that Brisbane and Adelaide are starting to pick up, but nowhere near the energy that Melbourne and Sydney have. So confidence is a positive factor, Michael, and pent-up demand, I guess, is still being released in Melbourne and Sydney, given prices, although growing strongly, still remain below where they were at their peaks in 2017. So that does tell us that there's upside to prices. And of course, as we discussed regarding interest rates, which are certainly more likely to fall over the first half of the year, that's another positive in terms of improving affordability and working its way into confidence. And as I said, some improvement in the economy, very, very early signs to that will take that out of the focus in the shorter term.
And of course, the old supply-demand ratio is going to kick in too,
Yes.
as there's very little new supply coming into the market. But we still keep growing. The latest Australian Bureau of Statistics figures showed we added about 380,000 people, much the same as the year before, but we're not building enough, or we're not building the right sort of dwellings for them, are we?
Absolutely right, Michael. This is a real issue that will unfold itself over the next 2 years. We're just going to run out of housing. And the building approval data is really sobering. It's virtually collapsed in Sydney and Melbourne and Brisbane in terms of apartments, and just takes time, regardless of how strong demand is, for supply to match it. And this is going to create shortages of housing, and it's going to produce other issues in terms of lack of job opportunities in the building sector. And this again gets back to the issue of trying to manipulate markets, which the financial regulator did through 2014 and up to 2018. And what's resulted in that, of course, is lack of new supply coming through as a direct consequence of those particular policies. And that will take some time to right itself, Michael, and it's only going to mean upward pressure on prices and rents.
Well, another interesting year ahead of us. There are some headwinds, as we said, but there's lots of positive signs. So I look forward to having a chat with you each week, Andrew, as we unpack what's happening in our property markets. Thanks for your time today.
Thanks, Michael.